It's the Real News Network. I'm Sharmini Pierce coming to you from Baltimore. With the incoming Trump administration, the topic of U.S. trade relations with China have recently moved to the forefront. Trump and his advisors are saying that China is violating international trade rules and that the U.S. should retaliate. Meanwhile, China is warning Trump not to launch a trade war with it. It is also fortifying its military presence in the vital trade route known as the South China Sea. Left out of this debate is how is China doing economically, its economic growth, and still you would find that China is among the strongest in the world when it comes to the economy. However, it has significantly slowed down in the past few years. One economist who is warning that China could be facing a serious economic crisis is Richard Vague. Richard is joining us today to take a closer look at the Chinese economy. He's the managing partner at Gabriel Investments and chair of Governors Wood Foundation, and he's the author of The Next Economic Disaster: Why It's Coming and How to Avoid It. Thank you so much for joining us today, Richard.
Thank you for having me.
So, Richard, in your book, The Next Economic Disaster, and in your article that we've read here in Democracy Journal, you provide a fairly comprehensive explanation for why China's economy is facing a serious problem and could enter into a major financial crisis, similar to that one that the U.S. experienced in 2008. So give us a better sense of what your key arguments are for that.
Yeah, well, all major financial crises, certainly ours in '08, certainly Japan's in the early 90s, Asia's in 97, and many others we could name, have all been built or caused by very rapid run-ups or increases in private debt, non-government debt. In the U.S., it was housing. We just built way too many houses. We've made way too many mortgages at unrealistic valuations, and it kind of all came tumbling down. And Japan in the early 90s, during the 80s, their private debt had grown astronomically, primarily in commercial real estate, but in other areas as well. We've observed that when private debt to GDP, private debt in ratio to GDP, increases by about 20% in 5 years, and private debt levels are already at a relatively high level, you almost always end up with a financial reversal, financial calamity, or even a financial crisis. The threshold being 20%, China's been growing its private debt to GDP over a 30 or 5-year period at 30+%. And that hasn't slowed down at all for all their rhetoric. And all that private debt has ended up in ghost cities, in overproduction of commodities. They've just overproduced on an unprecedented scale. And they kind of have to slow down. There has to be a reversal over the next few years to compensate for that.
And you're saying a slowdown would be what would be required for to avoid impending financial crises?
Well, I think there's going to be a slowdown no matter what. China is awfully skilled at propping up zombie banks, and they did that in '99 in a profound way. They can probably do that again. They can paper over, they can create accounting fictions, they can do whatever. But the amount of overcapacity that China has means that ultimately China's GDP has to slow down, probably to a low single digits type of a rate. What they're doing is eerily parallel to what Japan did in the 80s and early 90s. And you can see the overcapacity and overlending that happened there, the recapitalization that had to occur at the banks in the 90s. And you can also see that their growth has been near zero in the 25 years since then. It hadn't been a lost decade. It's been a lost generation. That was really because they overdid it in a massive way in the 80s.
Right. And because the world economy has been slowing down, there's less a need for some of the Chinese goods produced. Is that causing a slowdown as well, or is there internal demand that's compensating for that?
The internal demand isn't even close to compensating for that. China had almost 10% to its GDP, net positive exports in the 2000s, really built on the debt bubble that was occurring in Western Europe and the United States. When that went away in '08, China was really faced with a decision to allow its growth to slow down precipitously as a result of the world slowdown, or to try to compensate for it elsewhere. And the way they've compensated for it is through private debt growth. Since that time, China's non-government private debt has increased by the equivalent of 19 trillion US dollars. It's unprecedented.
Now, turning to our new administration here in Washington, as I mentioned in the introduction, Trump has been arguing that U.S. ought to retaliate against Chinese violations of international trade rules. And what do you make of Trump's approach to U.S.-Chinese trade relations, and how is this attitude going to impact the actual trade balance?
You know, unlike many economists, I'm not a religious, I don't have a religious belief in free trade. I don't think it's always the best thing. The United States was the most protectionist nation on earth from the mid-1800s to the early 1900s, and we grew from an also-ran to being the largest, most powerful country in the world in that very period. Ronald Reagan in the 80s got tough a couple of times with Japan. You know, he announced a 100% tariff on certain categories of Japan imports and got fairly quick cooperation. I think there's an argument to be made that we have been a little soft on trade issues, often in exchange for political gains. And, you know, I think the American worker has gotten the short end of things really since, you know, in a kind of a profound way when China entered the WTO. I believe that was under Bush. No, it was under Clinton. And so I think, you know, I think there's reason to think we should be tougher with China. And frankly, I think we hold a few more cards than China does in any dispute that we might have. Nevertheless, these things are hard. They're often ugly. And a lot of the big trade deals have long since been made, and you know there's not a lot of room for retrading. But I do have some sympathy with the idea that we ought to be a little tougher with China. Their markets aren't particularly open to the U.S. They do a lot of things that make it very difficult for U.S. businesses to do business in China. That has gotten markedly worse recently, especially with the capital controls that they're putting in place. So, you know, it's not, there's not really, you know, good reciprocity. I think there's room for a little more tough stance.
Now, the U.S. does rely heavily on China in terms of its own growth. Now, given that the U.S.'s major production now is dependent on the financial sector and not actually on producing and exporting goods, and it's been like this for a very long time. But China also buys the bonds, American bonds, and so we are heavily tied to the Chinese economy doing well for the U.S. to do well. In fact, the Chinese Foreign Ministry actually fired back to some of Trump's comments recently by saying, you know, it would be counterproductive and contrary to the best interest of the United States to pursue these lines of a trade war that they call. What do you make of that?
Well, I think the financial side of it, you know, respectfully, I think the financial side of it is a bit of a red herring. We have about 19 to 20 trillion dollars in aggregate U.S. debt. And China holds about $1 trillion, maybe $1.3 trillion at this point in time, and that amount has been declining. I don't think the fact that China holds our debt is really an issue to us one way or the other. We're going to be fine. The markets globally are deep and wide for our debt. So putting that issue aside, however, there's a lot of complexity in our relationship with China. You know, Apple manufactures, you know, a healthy percentage of its iPhones in China. And alternative manufacturing sources for that are going to be difficult to establish quickly. It's a complicated issue. I think we're holding a few more cards. It's going to be a hard one to play through. But I'd repeat the idea that the United States probably holds, a few more cards than China does. The U.S. is double the size of China from a GDP standpoint. And other markets, are starting to emerge as manufacturing powerhouses in Southeast Asia. I've seen an analysis recently that shows that Mexico's manufacturing, the cost to a United States concern for certain types of manufacturing in Mexico is actually at parity or maybe even slightly better than China. So, there's alternatives for us. It's just certain areas are complicated and going to be hard to navigate.
Right. Regardless, our economies are intertwined. What do you think a sensible trade relations with China would look like?
I think if you'd asked me the question 5 or 10 or even 15 years ago, I would have said then that being more assertive in what we require of China to be open to China would have been in order. The problem today is we're so much more intertwined than we were. Plus, and this is a fundamentally underappreciated fact, China's in a very fragile situation. We could be the entity that precipitates the crisis in China that I've written about. And I don't think that's to anybody's advantage, because there'll be a kind of a spillover effect of that or contagion effect of that. China's, 1/3 of GDP growth now, so we got to navigate that carefully. So I think somewhat more assertive with very intelligent requests for the kinds of things we want is in order. Whether Trump is capable of handling that remains to be seen.
All right, Richard, I thank you so much for joining us today and very enlightening conversation.
Well, I'm grateful that you reached out. Enjoyed the conversation.
All right, and thank you for joining us on the Real News Network.